want an exposure to a market or an
Everything they need in one place.
The world's foremost authority on individuals, advisors and institutions.
Hello and welcome to Morningstar. I'm Emma Wall, and here with me today is Tim Stevenson to give his 3 stock picks, manager of the Euro Trust. Hello there.
Good morning, Emma. Hi.
So what are your 3 stock picks?
Well, within my portfolio, which is usually around about 50 positions, there's obviously a whole spread of things from pharmaceuticals, transport companies, some cyclical companies and so on. So there's always a big risk in terms of just naming the 3 that, for all I know, may come out with some bad news at any stage over the 6 months. So I'd be very wary about sort of jumping onto any of these ideas if anybody wants to take a short-term view, because they could well lose their money. So be very careful about it. But the sort of names that I like are companies that have really got sort of self-help and real big potential. So if you look at the largest position in the portfolio, which has been there for some time and has performed very strongly over the last 12 months, Deutsche Post, which is the parent company of DHL, that's a very widespread business. It obviously runs the mail business in Germany and runs that quite efficiently. When you look at the Royal Mail in the UK, it's interesting that Deutsche Post has only just put through its first price increase this year, first price increase in 15 years, not 15 in the last 5 or whatever we've had in the UK. So the actual mail business in Germany is doing okay, but in the meantime, the DHL business is doing extremely well. They have a 40% market share of logistics in Asia, for example. So they have a really good dominant position in an area like that. So that's a sort of good self-help, but also growth and related to global trade story, which I think has got good potential.
What are the risks with that stock?
The risks obviously are sort of a global slowdown, more intense competition, irrational pricing from peers that are struggling, that kind of stuff. I think the risks are less in the actual mail business. Obviously, mail is in long-term decline in all our countries, but there still is a sort of core mail business that actually carries on going ahead. But you're receiving anyway a dividend yield of 2.5% to 3%. That's on historic dividend, and the chances are they'll increase it anyway. So you're being paid to wait, and you're being paid a lot more than you're getting in putting your money in 10-year German bond money, for example.
And what's your second stock example?
Another one I would give is, say, Pandora, which is probably known to a lot of people, the jewellery company. As you can probably tell from the fact that I don't wear any earrings or bangles, that I'm not a great expert on their products. But in terms of the growth that that company is seeing and the rollout of new products, it's doing extremely well. And I'm still confident that that will continue to grow because it's got the right kind of price points. And it is kind of affordable, but also very tasteful jewellery. So perhaps my children would expect, my girls maybe might expect some of that for Christmas, but that's given the cat out of the bag anyway.
And is that stock capturing the sort of emerging market arena as well?
There's a little bit of that, but more sort of on the emerging market theme. I would sort of look at a name like Essilor, say, in lenses. They make the lenses of glasses, for example. That's bigger in an emerging markets field, because that's where people are beginning to spend more money trying to be able to see correctly, rather than sort of walking into lampposts the whole time and so on. So they are actually upgrading their whole sort of lenses. And that's more of an emerging market play, but plus the sort of developed markets are actually moving quite fast, because as you get older, then so your eyes change and you need more complex glasses, which inevitably then cost more money.
Is that quite a competitive market, though?
The lenses market it's not that competitive, actually. I mean, there's probably only about 3 or 4 players globally, but it's been much more competitive over the last 12 months, which is why the Essilor shares have been performing quite badly. Partly they were quite expensive, and they still indeed are quite expensive share, which is what you often find in my holdings, is you pay for the quality you're actually getting. But they've also suffered a little bit from more intensive competition from a competitor, Hoya, who was out of the market effectively because of the major flooding in Thailand a couple of years ago. So you're now sort of getting the rollout of that effect coming through, but that's certainly had an impact on the pricing in the short term. But ultimately it's about innovation and the quality, and innovating new products. For example, one of their products which filters out the harmful cancerous rays in sun. So again, that's a real kind of must-have additional coating that you can now get on your glasses to protect your eyes from the harmful rays of the sun.
Tim, thank you very much.
Thank you.
This is Emma Wall for Morningstar. Thank you for watching.